This is your host, Mr. John Legaretta, and I'm super excited to bring you guys right now today a brand new video series called Our Beginners Ramp Up for Forex Trading course, guys. Right, there's going to be a few videos that we are going to be releasing in order to help you guys expand your awareness and reach a higher level of performance when it comes down to making money, inside of the markets. Now, before we go ahead and get started, I want to pull up this quick disclaimer so everybody can definitely be, on the same page. Understand that as a trader in any sort of market or as an investor just in general, okay, nothing and no returns are ever guaranteed. Understand right here, past performance is not indicative of future results. A trader who has been successful for a substantial amount of time may not always be successful. And the decision of whether to use the service offered is that of the client alone. The decision of which trade to copy is literally that of the client alone. And any trades are the responsibility of the client alone. So what is that saying? That ultimately you have the ultimate choice, right, on your screen to be able to act or not act on the trades that are being sent out or on the information that's given. You have the ultimate decision. Now, with that being said, guys, let's go ahead and get straight into the information. I remember when I first got started inside of this industry, I was very scared and very nervous. I wanted someone to really go ahead and show me exactly how this industry works step by step. And I was very afraid that whoever was showing me this information wouldn't really explain it in such a simple way. So I'm going to be talking to you today as if I was that person speaking to my old self in order to really help me understand this information in the simplest way possible. So I created maybe like a 5 or 6 segment little curriculum in order to be able to help you understand, how this market functions and how you're able to make money from it. So with that being said, let's get straight into the information, guys. If you have a notebook, you have a pen, or you're taking down notes somewhere, this is highly encouraged, okay, for you guys in order to better your education. So let's go. This is obviously the Forex market, or in this case, a foreign exchange market. The first thing I want you to be aware of is that this market is open 24 hours a day, 5 days a week. The market actually opens Sunday at 5 p.m. Eastern. It runs 24 hours Monday through Thursday. And then it goes ahead and it closes Friday at 5 p.m. Eastern, guys. So essentially, right, again, 24 hours a day, 5 days a week. After Friday 5 p.m., over the course of that weekend, the market is completely frozen. You're not able to take any trades. Okay, you're not able to close out any positions. So you can't really do anything when the market is closed. The market's not even moving, but the market will obviously resume Sunday at 5 p.m. Eastern. Now, guys, understand that there are 3 main sessions that we do trade mainly, okay? The very first one is our New York session, and that is from 8 a.m. to 12 Eastern. And this is when the market is very volatile. This is when the market is absolutely moving the most. It's one of the biggest sessions in a 24-hour period. The second session is called Tokyo session, and that is from 7 p.m. to 11 p.m. Eastern. And then we have the London session, which is 3 a.m. to 7 a.m. Eastern. Now, what I want you guys to understand, the 2 biggest sessions here are New York and they're London. Any professional Forex trader is either trading most definitely one of these 2 major sessions. So it's 8 to 12 or it's 3 to 7 that they are up and they are actively working the markets. Now understand, guys, in the foreign exchange market, there's 4 different types of instruments. When we talk about Forex, there's 8 major currencies in the foreign exchange market. We have USD for US dollar, AUD for Australian, NZD for New Zealand, CAD for Canadian, EUR for Euro, GBP for Great Britain Pound, JPY for the Japanese Yen, and then CHF for the Swiss franc. So US dollar, Australian dollar, New Zealand dollar, Canadian dollar, the euro, Great Britain pound, Japanese yen, the Swiss franc. Now, we also do a bit of some crypto trading, okay? Digital currencies like BTC for Bitcoin, ETH for Ethereum, and then XRP for Ripple. Number 3 is we also do indices as well. Now, many people are going to ask me, what is an indice? An indice, like you see right over here, US 30, NAS 100, and SPX 500, what would we consider this? We would consider this the collective performance of either the top 30, 100, or 500 companies in the US. So if the top 30 companies in the US, are reporting earnings that are significant, right? That are great for each company, then obviously the market's going to push up. So that's just kind of a little example. So it is a collective performance of the top 30, 100, or 500 companies in the US for US 30, NAS 100, and SPX 500. Guys, we also do commodities, okay, like physical goods. But the main one that we do use is, the symbol is XAU, but that really stands for gold. And very seldom do we trade silver, which the symbol for silver is XAG. Now, what I want you guys to understand is you can mix and match these different currencies. So when we actually trade, we don't trade single currency, guys. We trade in something called pairs. So you're going to see something like Euro USD, right? USD JPY. Okay, you're going to see something like AUD CHF. Understand, guys, that there are 28 plus pairs that we actually do trade when you do go ahead and mix and match every single one. There are 28 pairs, but this is something you guys should definitely take a note of, as we do trade most of these instruments that I have mentioned here. Now, before we go further, people are going to ask me, what am I looking at here? I've always been confused. I don't really know math, but what am I looking at this chart at? Well, guys, this chart to break down is actually very simple. What you guys are looking at is something called a candlestick chart. Because if I zoom in, each little individual icon looks like a little fat candle, right? Now, you have two parts to the candle, guys. You're going to have the body, okay? And then you're going to have the wick. I'm going to make this proportional, so don't kill me here. This is just a quick example. So this is the body, and this is the wick of the candle. Now, guys, understand that the market can move in only 3 directions, okay? The market can move up, the market can move down, and the market can move sideways. Now, the way that the market moves sideways, guys, is actually very, very simple. If you look at your upper left-hand corner, you're going to see the type of pair that we're looking at right now. So we're looking at euro to the US dollar. And right next to it on the right-hand side, you guys can see the different time frames. So again, market can push up, market can push down. But the way that market pushes sideways is through time. So in this specific chart, we have every single candlestick representing 1 day. But I can also put every single candle representing 4 hours or 1 hour. And there's multiple time frames, minute time frames, second time frames, weekly time frames, monthly time frames that you're able to put the chart at depending on exactly your type of trading style. Okay, so candlestick chart, you have the body and you have the wick. Okay, on the upper left-hand corner, you see the type of pair that we're trading, and the market moves sideways through time, and you're able to select the time frame that you want to look at the market at, whether it's very close up or whether it's very far away. Now, guys, we go on to segment number 2, and I want you guys to understand this is very simple, guys. In this Forex market, we are doing two things. We are buying and we are selling. When we place buy trades, we are essentially projecting that the price of the currency or the instrument will rise. And when we sell, we are projecting that the price of the currency or the instrument, right, could be indices, could be cryptocurrencies, could be gold, right, a commodity, that they will drop. Now, what I tell all of my students is understand that we are not physically buying or selling or owning any of these. Just because it says buy does not mean that we physically own. We're not physically buying it, okay? Essentially, we are betting that the value will either go up or go down. So if we place a buy trade, what are we doing? We're not physically owning anything. We are what? Projecting. We are placing a bet that the price of the currency will rise. When we sell, we are projecting, or in this case, betting that the price of the currency will drop. So in this market, this is completely, recession proof. We're able to make money on the way down. We're able to easily make money, on the way up. So the only way to lose money is if the market pushes in the opposite direction of what you bet. So what's a really good example here? If you place a buy trade expecting the market to push up, but instead of the market pushing up, it pushes down, you start to lose money. Because why? It is going in the opposite direction of your buy. Now, if you place a sell order or a short position, you can also say that as well, and we are projecting that price will drop, but what if it doesn't drop? What if price pushes against you and it starts going up when you place a sell order? Since it's going in the opposite direction, you are losing money. So how do you make money? By projecting the price of the currency correctly. How do you lose money? When the price of the currency pushes in the opposite direction of what you bet. Now, we move into phase 3, guys. Phase 3, segment number 3, the third segment is, I think, the most complex thing. But since you have a great mentor and a great educator, I'm going to simplify it for you. What I want you to understand is when you see this chart here, guys, I want you to understand that the price of the market is on the right hand side. Now, I don't want you to think like that's like a dollar sign, okay, because it's not. It's just a number on a screen that represents where the price of the market is. So right now, the price at this point for this pair is at 1.15949. This is the current price of the market. Now, how does the market move, guys? Very simple. The market is going to move in something called pips. So what are we always doing as traders? We are always counting pips. Now, what exactly does pip stand for? You see, pip stands for point in percentage. It is an acronym. But someone's going to ask me, well, John, what exactly is a pip? Because point in percentage, like, okay, cool, but what does that really mean? Well, a pip is a simple unit of measurement. It's how we measure the market going up, and it's how we measure the market going down. Now, I want you guys to understand that anytime you ever place a buy order or a sell order, buy trade or a sell trade, same thing, you're going to have an entry price, right? Now, understand what we are always looking for when it comes down to pips, right? Is this right here. This definition here is absolutely everything. A pip is always the second to last number to the right of the decimal of the entry price. Guys, again, anytime I buy or sell, I have an entry price. So if we were to enter, let's say, a trade right now, guys, for Euro USD, I'm going to write this down. The price right now for Euro USD, right, the entry price, I'm typing this down. The entry price right now is 1.15949. What I want you guys to understand is the last number, ladies and gentlemen, that is going to be considered your micro pip. Okay? And what I want you to know is that it means nothing. Okay? It's insignificant. Okay, I'm not going to type the whole thing out, but just it means nothing. It's insignificant. Don't ever look at the last number of an entry price. Why? That is the micro pip. That is not the number we're looking for. Remember, the pip is the second to last number, which is how we measure the market. So in this case of this entry price for Euro USD, the last number is the 9. That'd be the micro pip. So that means that the second to last number is this 4. Now, do you guys see this price that says 1594, but the 4 is a pip? Well, ladies and gentlemen, let me show you a quick example. If we place a buy trade right now, okay? Obviously, with the buy trade, guys, we want the trade to go where? Up, because if it goes up, what do we make? We make money. So understand this, we enter a buy trade, I put but, we enter a buy trade at 1594, and we expect the trade to go up because when the trade goes up on a buy, we make money. Now, how do we count pips, guys? If this thing goes from 1594, let's say it goes to 1.1595. How many times did the number change when it went from 94 to 95? From 4 to 5, that number changed one time, so that is considered 1 pip. Well, what if the market starts, pushing up some more? 1.1596. From 94 to 96, that is going to be a 2 pip difference. One more example. Guys, what if the market goes to 1.15, let's say 99? Okay, 99. Guys, that is going to be a 5 pip difference, right? 5 number change, 5 pip difference. Guys, the same way that the market can push up in pips, it can also go down. What if the market drops down to 1.15, right? 84. 84. So from 94 to 84, we can clearly see that this is a what? A 10 pip difference. Guys, what if we go down to, 1.1574? This is going to be a 20 pip difference. So you guys are able to see that second to last number is absolutely everything when it comes down to it. Now, this is on one currency, Euro USD. We can go to another one. Another popular currency, guys, to be able to trade is USD Cad. What is the price of USD Cad right now? Let's write it down together. We look to the right-hand side, and we can see the price is at 1.2356. You guys can see I did not even mention the final number, because the final number is the micro pip. Guys, this is the entry price. Okay, this is the entry price. So let's say we go from 1.2356. Let's say we go from there to 1.23, let's say 76. That is going to be a 20 pip difference. Okay, let's say we go from 1.2356 to 1.2300. That is going to be a 56 pip difference, right? Do you guys see from 56 to 00? There's a 56 pip difference there, and the 23 goes ahead and remains the same. So that is essentially how you guys are going to count pips, okay? That was your segment on counting pips. Some pretty simple stuff. We're going to move on to segment number 4. When we are going ahead and we are catching pips, how do we make money? Well, it's very simple. We make money in Forex through something called lot sizes, okay? What is a lot size? Your lot size is how much money you're earning per pip. Your lot size is how much money you are earning, or in this case, I would even go ahead and write down how much money are you betting per pip, right? So what are some different variations of lot sizes. I gave you guys a few different examples here. So your lot size will be on the left, and the amount of money that the lot size represents will be on the right. So here it is. So a 0.01 lot size represents 10 cents per pip. A 0.02 lot size represents 20 cents per pip. So let's actually go ahead and look, let's use a real live example. Guys, what did we say the price was? Okay, what did we say the price was right over here? The price is 1.1594. Okay, so really quick example here. What is the price? 1.1594. Now, let's say we go ahead and for this example, let's say we go ahead and we enter a sell trade. And again, where do we want the sell trade to go? We want the sell trade to start pushing where? Down. Because if it pushes down, we make what? We make money. So entry price, right over here, entry price, 1.1594. Now let's say, right, we put in a 0.01 lot size, right? A 0.01 lot size, guys, represents what? 10 cents per pip. So if we enter this, a 0.01, and we're making 10 cents for every pip, guys, if we start at 1594, right, 1.1594, and we go down to, let's say, 1.1584, this is 10 pips, right? But how much money are we making? I say making because it's a sell. How much are we making per pip? 10 cents. So 10 cents, right, per pip for 10 pips on this specific 10 pip move, you're simply going to make $1. Okay? What if this thing pushes down, let's say, to 1.1574? Guys, this is going to be a 20 pip move. Okay, this is 20 pips. So 20 pips times the 10 cents, this is going to be $2. Now, mind you, this is the least amount that you guys are actually able to use per pip. Okay, so I want to make you guys aware of that. Just so when you guys are looking at the numbers, you're not like, oh my god, this is so small. But this is it right here. Now we're gonna keep playing with this example, guys. So any number, the final number that's over here on this right hand side, this is going to represent your cents place. You can do 0.01, 0.02, 0.03, 0.04, but guys, once you reach 0.10, that's where you start earning $1 per pip, and you can select that whenever you want. So 0.10 represents $1 per pip, right? A 0.50 would represent $5 per pip. I would go ahead and tell you that this specific number right over here, right after the decimal, this is your single digits place as far as money you're earning. So any number that's here, you're only earning single digits, $1. 0.20, 0.20, that's $2 per pip. 0.30, $3, 0.50, $5. And then the final type of lot size, right, is this right over here. It's 1.00 represents $10 per pip. So I would say any number before the decimal is considered your double digits, okay? Any number here is considered your double digits. So 1.00, $10 per pip. 9.00 is $90 per pip. Guys, if you went ahead and let's say, just for this example, let's say you went ahead and used a 9.00 lot size. This represents what we just discussed, $90 per pip, correct? Gonna take this over here, gonna take this out, $90 per pip. So if we go ahead, guys, and we simply move 10 pips, guys, if I do 90 times 10, guys, in a 10 pip move, that's $900. Guys, we do a 20 pip move at this specific lot size, guys, this is going to be $18 $100 in a 20 pip move. So understand this, the balance that you have in your trading account will determine what lot size you would use per pip, so you're not too over leveraged or you're not too conservative in the positioning of your trade. Now, we will discuss that more in the video collection as far as which lot sizes to use, per account size, so you guys have something to follow. But we're gonna go on to the fifth segment and understand that when we are taking any trade, there are 5 major components of every single trade that you're going to take. The very first one is the type of instrument, or in this case, the type of currency. So is it Euro USD? Is it AUD JPY, USD JPY, Euro CHF, whatever the case is. The type of instrument, the lot size, which is how much money you're going to be betting per pip. The entry price, which is obviously the point of entry, right, when you bought or sold. Your stop loss is considered as your risk factor, and then your take profit is considered your reward factor. So you always have a stop loss, you always have a take profit. If you go ahead and enter a trade, the stop loss will completely take you out at your desired point of ultimate risk that you decide, and your take profit will automatically take you out at your point of reward without you having to do anything. When you guys place these trades onto your MetaTrader 4, I want you to understand, whether you're sleeping, your phone could be completely dead with no battery, the system recognizes your stop loss, the system will recognize your take profit, and it'll take you out at these positions that you have marked up. So these are the 5 major components of every single trade. Anytime that we enter a trade, these are the 5 things that you're going to be entering into your MetaTrader 4 in order for you to complete a real trade. Okay? We move over into, I believe, the final segment, which is helping you understand risk management. Now, what is risk management? It's understanding, let me go ahead and fix this real quick. Guys, it is understanding how much, there it is, how much you are actually earning or losing per trade, and mastering being in control of the amount that goes in and out of your account. So a lot of people may be afraid that you're going to lose thousands or even hundreds of your hard-earned money, and I want you to understand that that's not true. As long as you have a proper stop loss, you can be in control of the amount that you earn. And with the risk management, you can also be in control of how much you actually lose. Now, guys, when it comes down to trading, I want you to understand this. There's something called, again, risk to reward. And here's 3 different examples that we use. A 1-to-1 risk to reward, as an example, is on a certain trade, when we enter a buy or sell, we may be risking 10 pips in order to catch 10 pips. So the amount that you're risking is the same amount that you are what? Gaining. Okay? So that would be considered a 1-to-1 risk to reward. A 1-to-2 risk to reward would be like risking 15 pips, but you are actually earning double the amount. Only risking 15, but you're able to catch 30. But where real traders reside is in 1-to-3 and above. A 1-to-3 risk to reward ratio is risking 20 pips in order for you to catch 60. Now, this is important. Why? Well, here's an example, guys. What if we take 2 trades today and you lose 20 pips? I'll put lose. Let's say you lose 20 pips on this trade. We take a second one where you lose 20 pips on this trade as well. Okay, so you lose 20 pips, lose 20 pips. That's 40. But what if you win just one? And that one that you won, you actually earned a total of 60 pips. So you lost 40, you caught 60, even though you lost 2 trades and you lost more than you won, you still won more than you actually lost. So I know professional traders that they don't have the best winning percentage. They might win 6 out of 10 times, 4 out of 10 times. What's more important than your win ratio is your risk to reward ratio. 2 losses, 1 win, you're not even at break even. You actually are up 20 pips. Nonetheless, what if you lose a third trade at negative 20 pips? Guys, at this point, you lost 3, you won 1, but now you guys are at what? Break even. So I want you guys to really understand the very next portion is, how do we actually calculate how much money we are losing and how much money we are making? So I'll give you a real example after I share this formula. So this formula we use, I want you to write this down, is pips times lot size equals dollar amount. Well, what do I mean? Guys, here's an example of a trade signal. Guys, you remember the 5 major components? Number 1, the type of instrument that we are trading, Euro USD. What are we doing here? Guys, we are buying this trade. Hypothetically, let's say we enter this trade as a buy by market, which means we're going to execute the trade immediately. So the type of trade, right, buy or sell. Then over here, you guys have your entry price, $15.94. Your stop loss is 20 pips. From $15.94 to $74. How many pips are we risking? 20. And when we go from $15.94 to $16.54, that difference from $15.94 to $16.54, this is a 60 pip difference, but since it's going up, we are catching 60 pips. Guys, this is a 1 to 3, right, risk to reward ratio. Now, real example, let's use this formula. Let's say for this example, guys, we have $1,000 US in this account. You know what? An appropriate trader doesn't risk too much. So let's say over here, our lot size, which would be a decent appropriate lot size for this trade, guys, would be a 0.20. Now, what does a 0.20 represent? A 0.20 represents, that's in the single digits place. It represents $2 per pip, guys. $1,000 in your trading account. Your lot size is 0.20, which represents $2 per pip. So over here, we are risking what? 20 pips, guys, right? Pips. How many pips are we risking? 20. What's the lot size? 0.20. But John, what does that represent? That represents $2 per pip. Pips, risking 20. The lot size amount, $2 per pip. So 20 times 2, guys, on this trade with that lot size, you are literally only at risk of losing negative $40. Now, we go ahead and we use the same formula for the win. Okay, right over here. Lot size still $2, but instead of using the risk, we are using the reward. So what's the reward in pips? Reward in pips is what? 60. What's the lot size? The same one, $2. What is 2 times 60? Guys, you are going to be earning on this trade what? $120. Again, pips risking. Over here, 20 pips. What's the lot size on this size account? 0.20. But what does that represent? $2 per pip. Negative 20 times $2, you're risking a real $40 out of $1,000. Okay, that's fine. What are you actually making on this trade if you win the full 60? Well, how many pips are we catching? Pips. How many are we catching? 60. What's the lot size? The same one, $2 per pip. What is 2 times 60? 120. Risking $40 to make 120. Guys, what if you just did 120 per day? Okay, if you did 120 per day, right? Grabbing my calculator, you do 120 per day, and you do it for 5 days, okay? In 1 week, right, a full trading week, Monday through Friday, if you do that for 1 week, for 5 days, that's $600, right, for 5 days. Okay, so let's put that, that's 600 bucks for 5 days. And if you just did that for 4 weeks, 600 times 4, guys, that's going to be $2,400. Okay, for, there we go, $2,400 for the month. Over here, yeah, for the month. So understand that trading can honestly be very powerful. 120 per day, 600 for 5 days, that's 2,400 for the month. This is, supplemental income that you guys are possibly able to earn depending on your performance inside of the market. So with that being said, this pretty much sums up our very first video. Get back to the person that brought you on the video, keep finishing the course, and we encourage you guys to do very well right with us in our company. Thank you all so much, and I'll see you guys on video number 2.